civil wars within countries, international wars between countries. They happen when revolutionary new forces defeat weak old orders.
Ray Dalio has just sent a massive warning to the average American, stressing how we could all be hit by a huge, unexpected collapse soon.
When debts become very large, and there is an economic downturn, and the empire can no longer borrow the money necessary to repay its debts, the financial bubble bursts.
The next big concern is when the Federal Reserve and other central banks step in to buy debt again. After that, a major risk will emerge during the next economic downturn. Here's where the problem starts. Over time, we've allowed debt to pile up, and infrastructure has been left to deteriorate. Instead of tackling these issues, we've borrowed more, kicking the can down the road. But debt isn't just money. It represents productivity, and sooner or later, it has to be repaid. In simple terms, there are debtors, borrowers, and creditors, lenders, and the system has to work for both. Lenders need to be compensated fairly for taking the risk of lending money. When you take on debt, you're not only agreeing to pay back the amount borrowed, the principal, but also the interest. If this system breaks down, no one will want to lend money, and the entire economy suffers. When it comes to paying off debt, there are two options: pay it back with hard money, money that holds value, or print more money and repay it with devalued currency, inflation. Historically, cycles of rising debt have led to crises dating back to ancient times like the biblical years of Jubilee. As debt grows, it becomes harder for countries to keep up with payments, especially when debt servicing costs, like interest, get too high. If lenders, creditors, don't feel they're getting enough compensation, they'll start selling off debt. This could cause a massive imbalance between the amount of debt being sold and the demand for it, which can create economic instability. Central banks often try to step in by printing more money to buy back debt, but this devalues the currency and erodes confidence in the system. A prime example is Japan, where the government printed so much money that the currency lost a significant portion of its value, about 80% of bondholders' purchasing power. This creates a vicious cycle, and the U.S. could face similar issues in the future. As debt service costs rise, the government will be forced to cut spending, which will squeeze consumption and hurt the economy.
First, countries didn't have enough money to pay their debts, even after lowering interest rates to zero, so their central banks began printing lots of money to do so. Second, big internal conflicts emerged due to growing gaps in wealth and values. This showed up in political populism and polarization between the left, who want to redistribute wealth, and the right, who want to defend those holding the wealth. And third, increasing external conflict between a rising great power and the leading great power, as is now happening with China and the United States. So I looked back. I saw that all these had happened together before, many times, and nearly always led to changing domestic and world orders. The last time this sequence happened was from 1930 to 1945.
Looking ahead, the next risky moment will be when central banks have to intervene again, and this will likely happen within the next few years, especially during the next economic downturn. Historically, business cycles last about 7 years, give or take a few, so we could be facing these challenges within the next 5 years. A mix of gold with inflation-indexed bonds could be a great opportunity to sell to investors. Gold has traditionally been a good hedge against inflation. Moreover, it is a quite negatively correlated asset with the other assets involved, making it a solid diversifier. In general, gold always manages to keep its value during war or economic crisis. That is why people often refer to it as the safe haven asset. In recent years, central banks have been accumulating gold as reserve, and portfolios are generally underweight for inflation hedging assets. Hence, diversification into gold and inflation-indexed bonds could probably lower long-term risk. There has also been massive hype surrounding Bitcoin and gold, with people becoming pretty hysterical in their enthusiasm for one over the other. It is possible that Bitcoin has a lot going for it, though it probably won't provide much in the way of an opportunity for privacy, as it can easily be tracked and controlled by governments. The key takeaway here is quite broad thinking in terms of not putting all of your eggs into one basket regarding alternative money to the traditional currency. Bitcoin is quite unpredictable compared to other assets despite its recently galloping fame. Its past behavior is not enough to provide any clarity about the future actions it might take. Particularly, this is relevant when one bases their calculations on key factors that would drive the economy at large. Also, do remember that the market in Bitcoin is rather small. Just for perspective, the whole size of the Bitcoin market is smaller than major companies like Microsoft, by about a fifth its value. There is only one company and numerous others. For those reasons, Ray wouldn't be suggesting investing a lot of your money into Bitcoin. Central banks aren't going to be embracing Bitcoin anytime soon. They would rather store their money in gold for all eternity. Gold is the only asset that doesn't even rely on someone else's promise to pay you. So between Bitcoin and gold, you want to go for gold. At the same time, it's critical to stay diversified in your investments. If we ever face the kind of economic environment where traditional systems falter, you'll want assets that can quickly convert into real purchasing power. It's not just about holding money, but having assets you can use when needed. And privacy in those transactions could be important too.
First thing is you realize that holding cash and dead assets is a bad thing. So a lot of money is in cash because people think that cash is the safest investment. But they are measuring that in the amount of money that they get, nominal returns, and they say it doesn't wiggle much. But think about it. It's lost, as of the most recent statistics, 8.5% over the last, inflation is 8.5%, and they receive virtually no interest rate in cash. And so there was an 8.5% loss of buying power as a result of inflation. And so psychology should change, and is in the process of changing, to realize that you have to think in terms of buying power, not the number of dollars you have. And you have to think how much is your buying power. And so the worst thing is to be in cash. Like I say, cash is trash, and to be to be out of the bonds. The next thing is to have a diversified portfolio of assets. The diversification means some assets that are inflation hedge prone. For example, you're better off to own an inflation index bond than a regular bond.
The key to financial stability is having a clear understanding of your expenses and building a financial buffer. This means setting aside liquid savings for emergencies, investing in assets like your home, and covering essential expenses like education. Your home as an asset is important, and maintaining or improving it can act as a form of forced savings. You also need to factor in taxes and other financial obligations when planning. When it comes to investing, see it as having two main parts: safe investments that cover your essential needs, and more speculative investments where you try to outperform the market. Be realistic though, beating the market is tough. The basics of diversification and covering your financial needs come first. Above all, a saving mentality is critical. The power of saving over time cannot be overstated. Getting caught up in the short-term market movements, like whether interest rates rise by 25 or 50 basis points, often misses the bigger picture. The Federal Reserve's job is to keep interest rates high enough to ensure creditors receive a real return, but not so high that debtors are pushed into crisis. So whether the Fed raises rates by 25 or 50 basis points matters less than the overall policy and how it fits into the larger economic picture.
Is the country earning more than it's spending and building savings, or is it spending more than it is earning and creating debt? Because one man's debts are another man's assets. And when somebody is holding those assets and they're producing a lot more of that money in debt, they go down in value. Money goes down in value as they produce it to produce that buying power. And then that gets people bad returns, it produces a higher amount of inflation, and it produces bad returns for holding debt or bond. So in other words, cash or bonds, and then people get out of cash and bonds, and that produces rising interest rates while there's rising inflation, and that produces stagflation. So I want them to get the mechanics of that, because that's happening now. You could see it. This is not controversial. We are producing a lot of debt. We're spending a lot more than we're earning. And as a result, they're printing a lot of money. And the printing of a lot of money creates a lot of inflation. And with that inflation, then nobody wants to, cash is trash. You don't want to hold cash. And you get out of that. And that causes rates to rise.
One of the big forces we're dealing with today is the rising level of debt. We have enormous debt, and that's going to keep increasing. One person's debt is another person's asset. So what does that mean for the economy? To service this debt, real interest rates will likely have to remain negative for a while. This means inflation will rise, eroding the value of money, but nominal growth, inflation plus real growth, will need to stay above nominal interest rates. As a result, holding bonds becomes less attractive, which is a bad deal for bondholders. Real interest rates must stay negative to keep debt manageable. Right now, the economy is near equilibrium in many ways, aside from the debt issue. If you ignore the debt, things might even look relatively stable, with modest expectations for easing interest rates and a gradual move toward a more normal, positively sloped yield curve. But this is skewed when you factor in the rising debt and the uneven distribution of income across different parts of the population. Then there's the political landscape, which is another major force affecting the markets. Internal divisions between the political left and right create uncertainty, and that's going to lead to policies that could drastically change the economic outlook. This kind of instability makes it even more important to consider how diversified your portfolio is and to plan for different outcomes.
The second force that is dealing with is the internal conflict force, how you are with each other. Are you operating cohesively, common mission, and moving in the right direction, the system working? Or are you at each other's throats? Is the system threatened? Because history's shown when the causes that people are behind are more important to them than the system is in jeopardy. And that is a risky situation. It's a risky situation because it produces disorder, and it can produce a form of civil war. And at those times, when you have that, you see greater and greater polarity. In politics, it shows up at greater and greater populism of the left and populism of the right. And populists want to fight for their side. They're not moderates. Moderates want to work together to try to find a compromise that's best for the whole. Populists appeal to their crowd by saying, I am fighting for you, and they will fight each other. And that fight can be at the threat of the system. So in history, for example, we saw 4 democracies in the 1930s choose to become dictatorships as one side fights to the other because they become so disorderly. And we have a system right now that you could see that it is possible in elections that neither side might accept losing.
There are several significant challenges we're facing today. One of the biggest concerns is whether both sides in a political race will accept the results if they lose. Will we see an orderly transition of power? Will our democracy continue to function as a system where disagreements can be resolved without breaking down? These are uncertain times, and it's a real concern. Another major issue is the internal order and disorder in the country. The fabric of society feels more strained, and divisions are deepening. This leads to a situation where we have irreconcilable differences, not just about taxes and economic policy, but also about core values, like how people raise their children or views on issues like sexuality. The gaps between people are widening, and this is becoming more evident in our politics. It's hard to imagine a smooth, conflict-free transition when the divide is so pronounced. On the global stage, there's the third force to consider, the competition between major powers. Throughout history, rising powers eventually challenge the established ones, and right now we're seeing that dynamic play out between the US and China. This goes beyond economics. It's about national security, which makes it even more critical. Then we have acts of nature, droughts, floods, pandemics, and the broader impact of climate change. The cost of dealing with climate-related disasters is estimated to be around $8 trillion a year in a global economy worth $100 trillion. This isn't just an environmental issue, it's also an economic one, and it's going to have a massive financial impact on all of us. The fifth major force is technology. Human inventiveness has always been a driver of change, and right now we're seeing incredible technological advancements. Throughout history, technology has shaped economies and societies, and it will continue to do so. When you consider these five forces, internal conflict, global power struggles, natural disasters, technological innovation, and economic policy, it's clear that the world is facing major shifts.
There is a selling of dollar-denominated debt. So you're seeing that the bond market is going down and interest
started
rates
escalating recently?
Yeah, that's right. And so there is that dynamic that's going on. The capital wars are the ones that accelerate immediately before the military wars. Usually the coffers are empty, they're printing a lot of money, and then they're trying to use economics as a weapon. So we're in that part of the cycle. Now, in terms of how this will transpire, I think there are three big questions that we're going to learn about and get answers to pretty quickly. The first is, does Putin and Russia win or lose? I'll describe win as what he wanted at the outset, which is win for Russia would be to have the Ukraine be some non-threatening position, such as a neutrality, a guaranteed neutrality, and for Russia to have control over eastern provinces, and for Russia not to be economically devastated, instead to be maybe have something like a 10 or 12% decline in GDP, and for Putin to be in power. If those four things happen, then the cost of his actions will have been worth the what was obtained from that, and that would be viewed as a win. It would be then also a loss from the Western countries. The world is looking at the power of American sanctions.
Looking ahead, one of the most pressing questions is whether we can maintain an orderly democracy. It's remarkable that we even have to ask if we can have a peaceful transition of power in a democracy. But the reality is that the divisions in society are so deep that we can't take it for granted. Beyond the political divisions, we have big policy issues that need addressing, but they often get ignored. Take the national debt, for example. It's likely to keep growing, and at some point it will be monetized, meaning that debt will essentially be paid off with newly created money, which could lead to inflation. Tax policies also play a crucial role in how capital markets behave. Changes in corporate tax rates, for instance, directly affect the prices of assets as investors focus on after-tax returns. At the state level, we're likely to see more decentralization as states assert more control over their own policies, while the federal government may struggle to keep everything unified. This could lead to a more fragmented country where local governments have more influence over day-to-day life. How do you think things will turn out for all of us? Let us know in the comments below.